should I invest in certain ETFs or a certain type of strategy? Do I need to invest any differently when I'm debt recycling, or like, do I need something with higher income or lower income? Because, you know, there's taxes involved, and I'd like to get your thoughts on this. What kind of strategy have you chosen? And also, I suppose the thing is, a higher yielding or a higher income portfolio or options, if you've chosen them, will help you with the home loan repayments, but a lower yielding option will, I suppose, be more optimal for tax in terms of it creates a larger amount of tax deductibility, I suppose, because the difference between your investment income, your dividend income, and your interest expenses is going to be larger. So you're going to be in likely a negative cash flow scenario where you're able to then get an offset for those cash flow losses that you're experiencing. So let's walk through a couple of different situations of when someone might choose one versus the other, higher income versus lower income, and sort of investment strategy stuff.
Yeah, I'd call myself a bit of a baby with all of this, but I can at least talk through what I've done and why, for better or worse, which I kind of started off being like, I was looking at like listed investment companies and high dividend stuff like SYI ETFs and whatever else was just like high yield, high dividend. Because I was in that mindset of I want to put money in my offset to offset money paid every month so I can pay less money every month. So I was like, well, if I'm going to debt recycle and I'm going to pay more money every month to the bank, I should probably figure out a way to get money from the ETF to like pay that equally. Where I ended up though was thinking that, well, the thing about debt recycling is that if you own a home and you have no job and zero income, you can't really debt recycle, because, you know, one thing we spent some time gloss overing is that it simply lets the interest that you pay become tax deductible. So if you pay 10 grand of interest a year to the bank for a loan, a tax deductible loan, they take 10K off your income. And if you're the average Australian earning between like 40 and 130-ish, that means that you paid 10K interest on your loan. The government at tax return time says, we'll reduce the amount of money you owe us by 30% of 10K, which is 3K. So you get that like 3K benefit at tax time. So, you know, there's an inherent part of like the extent to which debt recycling is beneficial to you, like any deduction, is based on your income. If you're a high earner, you're earning 200K a year, it's an extremely tax beneficial thing. And if you're someone earning 30K a year, it's like not that tax beneficial. So one approach I took was like, if you're earning enough money, there's a meaningful tax benefit to it. What you're saying is that like, hey, I'm earning a lot of money, I'm going to get a tax benefit for it. But the flip side then of owning a high yield one is that the government's also pinging you for income at a higher level too. So let's imagine one of our listeners is, you know, $160,000, they're paying 37% tax. It's like, okay, cool. Debt recycling saves you 37% on your interest. But then if you're just getting dividends paid, the government's going to charge you 37% on your dividends too. So, you know, to some extent, like the better the debt recycling is, the more you get hit on the dividends as well. So the approach I've taken was to try and focus more on high growth asset, because I kind of had this revelation where I was like, actually, it makes sense to have these investments. They grow a lot in value, but they don't pay much dividends, because then hopefully one day, you know, in 20 years when I retire, I can just slowly start selling out my VGS or whatever when I don't have an income, so I don't get penalized much for selling it, and I'll just start buying up these dividend things and I'll live off those forever. And that was pretty transformational in me realizing that like I'm not picking a portfolio for life. I'm picking like investments that make sense based on like what I'm doing right now, and I can always find a way to shift towards that, because obviously I think I want a high dividend investment in retirement. It's nice and stable, it's nice and easy. No one likes to sell stuff, it's nice to just get income. But in the short term, I was like, well, these high growth, low yield ones will just mean I'm paying less tax now, or more technically, I can defer the tax payment to the future where I might actually pay less tax. But that might be a bit elaborate too.
It's a super interesting conversation to get into, man, because although what you're saying like makes perfect sense, because the larger the gap you create between your dividend income and your interest expenses, which is kind of what you're talking about there, that creates a larger amount of, I suppose, tax losses that you'll get the benefit from at tax time. So buying a lower yielding asset, say something yielding 2%, and then your interest payment is 6%, obviously there's a 4% gap, you might then save something like 2% tax. You know what I mean? Because you're getting 50, if you're on like 50% tax rate, super high tax rate, you get a larger benefit from that. Whereas if the dividend yield was higher, say 4%, 5%, there's much less of a cash flow loss. So although you're getting pretty good tax benefits because remember you've chosen to invest rather than pay down debt, so you're still getting that deductibility where you wouldn't have got it before if you didn't debt recycle. It's not quite as amplified as if you invested in a low yielding asset. So technically it's more optimal for tax to invest in something that's low yielding, but there is a little bit of a kink in that situation where it's maybe not quite as powerful as when you're discussing borrowing additional money to invest. So the difference, I suppose, with debt recycling is, remember, you've got a portion of your home loan that you've debt recycled to invest with. That's what we're talking about here. But then you've also got this other chunk of your home loan. Let's assume you haven't done it all at once. You're going to do it in stages. You've got this other big portion of your home loan here that is not deductible currently. So because you're trying to get that loan paid down so you can then debt recycle the next portion faster, it could be beneficial also to invest in something that is higher yielding, because that gives you more money to pay down the non-deductible debt faster, gives you more money in your hand to
It puts money in the offset account quicker. The one, your second offset account that's not yet debt recycled, right? Like you get more cash flow into it.
To then reduce that non-deductible debt faster so that you can debt recycle the next portion faster. Because remember, you're only getting a portion of the cash flow losses. You're only getting a portion of that back depending on your tax rate. So you could argue that it might be more beneficial to pay down, get a higher yield, but then pay down the home loan faster